Take our lead. Let's help you make your mark. Our goal is your satisfaction. Let us show you the way.
The term carried interest goes back to the medieval merchants in Genoa, Pisa, Florence, and Venice. These traders carried cargo on their ships belonging to other people and earned 20% of the ultimate profits on the carried product.
Take our lead. Let's help you make your mark.
The typical carried interest amount is 20% for private equity and hedge funds. For example, if the limited partners are expecting a 10% annual return, and the fund only returns 7% over a period of time, a portion of the carry paid to the general partner could be returned to cover the deficiency.
Make your mark. Take our lead.
Carried interest refers to a long-standing Wall Street tax break that let many private equity and hedge fund financiers pay the lower capital gains tax rate on much of their income, instead of the higher income tax rate paid by wage earners.
Take our lead. Let's help you make your mark.
Carried interest is the portion of the fund's profits that the general partner receives as the major part of their compensation. The general partner is usually a partnership of investment managers who contribute anywhere from 1% to 5% of the fund's initial capital.
Take our lead.
Executive summary. Carried interest is not interest income, interest expense, or a tax deduction. Carried interest has been used to pay enormous amounts to hedge fund managers who serve as general partners in investment partnerships.
Take our lead. Let's help you make your mark.
Carried interest, or simply carry, is incentive compensation provided to private equity fund managers to align their interests with the fund's capital-providing investors. Carry typically averages about 20% of the fund's profits and ranges from as high as 50% in exceptional cases to as low as in the single digits.
Take our lead.
Hedge funds have been able to avoid taxation by using carried interest, which allows funds to be treated as partnerships. Funds are also able to avoid paying taxes by sending profits to reinsurers offshore to Bermuda, where they grow tax-free and are later reinvested back in the fund.
Take our lead. Let's help you make your mark.
Unrealized, carried interest reflects profits that will be made and distributed when existing investments are exited sometime in future. Carried interest is only paid out once a fund hits a particular hurdle rate, usually a return of around 7% to 8% on its investments.
Take our lead. Let's help you make your mark.
When producing the NAV of the fund on either a daily, monthly or quarterly basis, the carried interest is calculated on a hypothetical basis to show the investor what the ultimate amount would be if they liquidated their account as of that date. The fee, however, is only earned and paid to the GP at year-end.
Take our lead. Let's help you make your mark.
2 means 2% of assets under management AUM, and refers to the annual management fee charged by the hedge fund for managing assets. 20 refers to the standard performance or incentive fee of 20% of profits made by the fund above a certain predefined benchmark.
Take our lead.
How to calculate for carrying amount. Take the original cost of purchasing the asset. Put together the depreciation cost for each year and multiply it with the number of years that the asset will be of use. Subtract the product from the original purchase price to get the carrying amount.
Take our lead. Let's help you make your mark.
What's the difference? When it comes to incentive compensation, fees and allocations are taxed differently. Incentive fees are taxed as ordinary income. On the other hand, incentive allocations, or carried interests, generally retain the character of the underlying fund's income and profits.
Make your mark. Take our lead.
Key takeaways: carried interest is a share of a private equity or fund's profits that serve as compensation for fund managers. Because carried interest is considered a return on investment, it is taxed at a capital gains rate, and not an income rate.
Take our lead. Let's help you make your mark.
The rationale of a catch-up is to give to the GP all or a majority of the gain, until the share of the profit received by the GP equals the carried interest, a percentage of the total return, e.g., 20%.
Thank you for watching. Please subscribe and hit the bell notification.